Welcome, everybody, to the Tuesday edition of the Not Your Average Investor Show. Today, we got some breaking news. Rates are falling. Interest rates are falling. We have been talking about this for a long time, but it's not just that interest rates are falling. It's why they're falling and what's happening next that's going to be of particular interest to the Not Your Average Investor. I'm your host, Pablo Gonzalez, in studio with my boy over here that I like to call GC because he's got the genius concepts. That's right. It's been too long. Genius concepts, generates cash flows, great co-host, and Greg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
It is good to be back in here with you, buddy. The energy is completely different when we're together.
It's awesome.
It's awesome. It's awesome. Speaking of being together, we want to remind you to save the date for our annual Not Your Average Investor Meetup, the long-awaited Not Your Average Investor Meetup. GC, what are the dates? February 16th and 17th?
Yes, they are.
Friday and Saturday, 2-day extravaganza, where we expect at least 50 people from our community coming out.
At least.
And that's kind of what we are figuring out with the guest list. So let us know ahead of time if you are coming. But you see, tell them a little bit about what we got in store for that.
You know, this is the third time that we've done this, and every time it has been such a great experience. This year specifically, if you're an investor and you would like to come and meet the JWB team, you'd like to see what turnkey rental property investing actually looks like, feels like, you're in for a great tour. We're actually going to take a bus tour into JWB neighborhoods. We're going to actually do a property of the week live for everybody there. So you get to actually see the type of assets that provide the foundation for all this financial wealth that we're able to create for all of our clients. So get to kind of check that off the list. Go down there, meet the team, get to see the assets. In addition to that, you are going to see downtown Jacksonville and get a sneak peek. You're going to see a look that nobody else gets to see as far as what a growing, revitalizing downtown looks like from a company that has invested $68 million in downtown Jacksonville. We're going to have a team of experts here to guide you and take you on a walking tour. So not only are you going to see the buildings that are now coming online and have gone through the renovation process or now have wonderful restaurants and folks living in these buildings that JWB and some of our other partners have been able to renovate downtown. But you're also going to see the future vision. We have some super cool things planned. We've got some VR technology where you're going to get to see what streets will look like in the next 2 years, 5 years for downtown Jacksonville. So it's going to be an experience like none other. So there's the downtown, what's coming next component. But the best thing of all is you get to reinforce and be a part of this special community, reinforce these relationships in this community. It's super special. We had folks that were flying in and driving in from all over the country last year to hang out with all of us. And I mean all of you who are not your average investors and have made it such a priority to invest in the community that we have here. So super excited for those three reasons. Make sure you block off those dates. It's February 16th and 17th of next year. And we're excited for you. We can't wait.
February 16th and 17th. The past other times have been a one-day event. This is a 2-day event. If you want to be there for all of it, just try to get to Jacksonville the evening of the 15th.
Absolutely.
Right? Like you won't miss anything. If you get here the evening of the 15th, you're good. If you get here 16th, first flight in, maybe you miss something, maybe you don't. So ideally, you're getting in the 15th. Just reserve that weekend. It's going to be a lot of fun. We're going to really we got some important people that you're going to meet that are going to shape the future of Jacksonville. We'll tell you all about that. You're going to see the cutting edge stuff, the VR stuff. I've seen this. It's super, super impressive, right? We're really going to see the future of Jacksonville, but more than anything, this is your opportunity to meet everybody else in the community. If you are a avid community member and you want to get to know all the folks that have all the different nicknames that you've been spending time with, all this, all these different Tuesdays and Thursdays here in the chat, you get to hang out and meet them. And equally as importantly, if you're someone that's thinking about rental properties and does this fit into your portfolio, who are these folks, JWB? Who are these people that invest with JWB? There really isn't another opportunity like this where you get to know if this thing is really for you, who else is doing it, why they're doing it, why it's worked. Ask untethered questions to folks in the audience that have a bunch of experience with this, that are going to give you their unbridled advice, along with hanging out with me and GC and the other shapers of Jacksonville future. So February 16th, 17th in Jacksonville. Hope you join us there. And I'm just going to call this guy out right here because he's the early bird. He already bought his plane ticket, rental car,
Love that.
hotel room, Dean Curry.
Love that, Mr. Early Bird. Of
True,
course he did.
True to his name.
And we will. And for everybody, I know you're asking, when can I sign up? When can I register? There is limited space, just like we did last year. We're going to have limited space again this year. We're going to be giving you an opportunity to register and sign up soon. It's coming soon. Maybe in the next show, maybe in a show right after that, but sometime very soon we'll have the registration open for everybody.
Real quick question from Mike Foster. Is there a cost to the February gathering? And do you know the start times for Friday and Saturday?
There is a cost. We're finalizing all the details, so we'll share that with you hopefully in the next 1 to 2 shows. And do we know the start times for Friday and Saturday? Finalizing those details as well. So I would recommend getting here Thursday night for sure. We're going to kick it off Friday morning.
It is not an exorbitant cost.
It is not.
Right. This is just make sure that you want to be here and cover some stuff.
It's a great event.
The cost is not gonna be the reason why you don't come.
Yeah.
Trust me, Mike.
JWB foots the bill quite substantially for this event, so everybody can have a good time when we have the lunch that's provided, the happy hours, all that good stuff. But yeah, we'll give you guys all the details soon.
All right. And speaking of having a good time, let's kick off with our usual call, which is the what, GC?
The roll call, baby.
Danny Davis is leading us off with a woo pig suey.
There you go. Better you than me.
John Henning.
The leadoff hitter.
The leadoff hitter. I'm reversed over here. Reverse order saying good afternoon. The MVP. Have you heard of him?
Mr. Lee Bishop.
Mr. Lee Bishop. I'm assuming he's going to be there. We got Chris Lee from Fernandina Beach checking in.
Chris makes it too. Chris, I think, deserves a nickname. Chris, we're much better though if you give us a suggestion. If you nickname yourself, it goes even smoother for us. But he's here every single show. I appreciate you being here, Chris.
Lee is a loyal follower, and he's not too far down the road. So hopefully he joins us also. We got the Mountain Man
Billy Green
from the frosty mountains of Colorado. We got the early bird checking in. We already teased him.
Dean, how are you?
Dean Curry in the house. Who else? We got the Maven from the mountains of Denver.
Leslie Wilson.
We got the Shaw man of the community.
Dean Shaw.
Checking in from Kauai. My boy, he's getting up early this morning in paradise.
There he is.
Beautiful. We got the Ringmaster.
Drew Barnhill.
We got Big Papa. I love it when he calls it Big Papa.
All right, Pops. Good to see you, brother. Can't wait to hang out with you. I'm taking my dad to go see a Steeler game this weekend.
Ooh, very nice.
I'm really excited. We do that every year.
We got Cody Adams in the house. She's our community manager.
Mama
bear of the community. If you need anything like extra information about the save the date, she shared a flyer in the chat, or any other dots you need connected. Check in with Cody there in the chat if she is checking in with you. Lita Song, beautiful investor from Minnesota. Good to have you. We got Luis Olivares from Miami. New name.
Hi, Luis. Welcome.
I am from Miami as well, Luis, but live in Jacksonville these days. Good to have you. Hope you make it a habit. Susan Parker back in the house. Susan making a habit out of it, saying hi, everybody, too, as well. Who else we got? Anybody? Oh, we got Bill Shields with a buenas tardes desde soleado Duva.
Well done, Bill Shields.
You like that, Bill Shields? Love when Bill Shields checking in. Janet Colvin is back, and she says she's coming this time.
Nice. There we go.
Can't wait to meet you.
If you're coming, let everybody know in the chat. We want to get kind of a feel for how many folks are going to be here from the
Barnhill says he's definitely coming. Lee Bishop says he's definitely coming. Who else? Suzanne Parker says, what's the date again? February 16th and 17th. Anybody else? Dean Curry, of course, the early bird. Always judicious in his plans. All right. Good roll call today. Ready to get started. Oh, Carolyn Moline are in the house. Patriarch and matriarch of the first family of the Not Your Average Best Show.
We salute you.
Laura Colby is in the house from Washington State. Right along, Raj is in the house. Raj Bantu saying hello all. We got some late checking inners. Good. I'm glad we scrolled all the way down. All right. GC. Big stuff. Oh, our favorite financial fiduciary, fee-based financial advisor friend, Kelly Barenbaum, says she will be there as well.
Excellent. She was there last time.
Kelly was one of those that was in the, is this really for me?
That's
Do I really trust everything I'm seeing on this show?
Mhm.
Right? She had not invested yet, came last year. Not only did she become an investor because of everything she saw and she liked, but she also got a client, me,
the best client,
and a friend, Kelly. It's good to have you coming on, and she's coming on the show again soon as another guest here. So happy to have her coming back. Medj Garcia in the house saying hello, everybody. Good to have you back in here, Medj. And somebody here, Not Your Average Guest, says I'd love to come, but I have no idea how to get invited or accepted to attend. Anything about that?
Keep tuning in. We're going to make that registration process really simple and easy for everybody. It's coming soon. So just keep showing up and we'll tell you how to do that.
All right. And Naveen Madali from Jacksonville is checking in as Not Your Average Guest. Good to have you, Naveen, in here. I don't know if that's you who texted us that, but if you check in from the text, you're shown as Not Your Average Guest. So you got to tell us what your name is or I don't know where you're at. Anyways, Chris Lee says beach viewer. That's what he wants. The beach viewer, Christopher Lee.
All right.
All
The
right.
beach viewer.
The beach viewer.
Okay.
All
I
right,
love
cool.
it.
All right.
The beach viewer. All right. Writing it down.
I got to remember that. All right. I may fail on this a couple of times. So if you check in with that name, that would really help me, Chris. All right. So, all right. Now to the thing that we came to talk about. We got Joni from Destin, Florida, checking in. Joni, good to have you as well. What we came here to talk about, GC, interest rates have been kind of the bane of our existence for the last year and a half, 2 years. Really, inflation has been the bane of our existence.
Remember we were talking about how the deal is the debt, and we're just talking about how much we love low interest rates. It's been a little while since we talked about that.
It's been a minute since Rich Ritchie came on here and talked about the deal being the debt. Afterwards, hedging against inflation became the deal. And now the Fed has been continually rising interest rates for a long, elongated period of time. We've seen this in other moments in history. So we know what the pattern is going to be. And right now we find ourselves in an interesting part of this pattern. And it's that interest rates have dropped, even though the Fed has not dropped the Fed's funds rate, GC. So before we go into what this means for investors and how to think about this from a not your average lens, you want to tell us what is going on with interest rates?
Yeah, absolutely. So I ran some of the stats here. According to Freddie Mac, 30-year interest rates on 30-year mortgages were 7.79% in October. And that was the high for 2023. So in a year of really high interest rates, getting close to 8% interest rates for a 30-year fixed rate mortgage, that was a lot for the real estate market. But now as we stand here, they're a little bit over 7%. So they've dropped 3/4 of a point in the course of the last few weeks. What's really interesting, though, is that many people say, well, the Fed controls interest rates for mortgages, but that's not really what happens, because the Fed funds rate, which is what the Fed controls, has stayed flat. But you've had long-term mortgage rates come down. So many people don't understand why that happens. And so we can kind of dive into that here. And then, of course, we'll get into what does that mean for you? How can you take advantage of a situation like this? But what's going on? You know, why are our long-term interest rates dropping almost 3/4 of a point when the Fed funds rate hasn't changed? Well, there's a lot of things that are happening here. We've talked a lot about inflation and inflation's effect on the economy, right? We talk about how inflation, of course, makes it more expensive for us to conduct our daily lives. But the inflation readings, the reason why we all are paying so much attention to the consumer price index, the inflation readings, is because it controls investor demand. It controls the Fed's actions. And as inflation was raging out of control, 4, 5, 6, 7, 8, 9% inflation, what the Fed did in response was raise the Fed funds rate to try to tame inflation. And you saw that to the tune of 11 rate increases by the Fed over the last roughly year and a half. I mean, that's largely almost unprecedented for the Fed to raise rates that high. Well, the Fed hasn't raised rates the last 2 meetings. This is the first time that they've kind of just said, okay, we're going to pause. We're going to keep the Fed funds rate constant. A lot of that is because the consumer price index has come down a lot. So the consumer price index, which is the generally accepted inflation metric that the government uses to measure inflation, now stands at 3.2%. That was unchanged from the month before. It's not at 2%, which is what the Fed's target inflation rate is, but it's a whole lot closer to 2% than 9%, which is what it was, midway through 2022. So you're starting to see that inflation number come down. You're starting to see inflation actually kind of just remain flat or not have these huge fluctuations, which gives people more confidence that it's kind of staying lower. And then you're also seeing the Fed in response kind of take a pause, let's wait and see approach. And so all of this really changes how people make investment decisions. And one thing just to point out, when we're talking about interest rates, we all think about it as us being the borrower. But there's an investor on the other side of the table there who is making a decision as to whether or not that return on investment is good enough for that person to put their money in. And so all of these things coming together have created this environment now where interest rates can come down, even though the Fed funds rate hasn't come down.
So if I was to summarize everything that you just said, the Fed is kind of like the biggest lever for controlling interest rates and whatnot. But there is also the market and the expectations of returns that people invest in across different asset classes. And one of them is these like mortgage-backed securities. And when investors realize that, hey, because the Fed has continued to raise interest rates based on this idea of inflation, when they believe that, okay, the Fed's done enough, the market is no longer doing the thing that we're all concerned about, they also have ways to affect the interest rate as well. And this is essentially where that's coming from. It's coming from people that sell investments that are based on these assets, predicting the idea that they're no longer exposed to the amount of risk that they were exposed to before based on inflation and increasing mortgage rates. Is that, or interest rates? Is that kind of it?
Kind of, yeah. Let me give a little bit more specific here.
Okay.
Okay, so there's really two components to the overall long-term interest rates that we all pay for our mortgages. There is the 10-year treasury yield. So 10-year treasury, right? Government bonds, basically debt that the government offers. And investors can make a decision to invest in a 10-year treasury. And then there's the spread or the premium that a mortgage-backed security investor will require in order to do that investment, rather than do a 10-year treasury. So 10-year treasuries largely are regarded as risk-free because it's the US government backing it and they can print as much money as they want. And then, so you might be able to earn, like right now, it's about 4.25%. You might be able to earn 4.25% if you want to go invest in 10-year treasuries. Or you could invest in mortgage-backed securities. You might be the note holder for all of our mortgages out there. And that there's more risk in that because we're not the government. So you're going to require a premium over the 10-year treasury in order for you to put your money in mortgage-backed securities. That make sense?
Yep.
Okay. So historically, that premium is about 1.7%. Sometimes it's a little bit more, sometimes it's a little bit less, but you can largely see that interest rates, 30-year mortgage interest rates, are about 1.7% higher than what the 10-year treasury yield would be at that time. Okay. So how does the Fed funds rate come into this? How does the Fed have a part in this? Well, when the Fed controls the Fed funds rate, which is the rate that banks borrow, overnight borrowing between banks, when they control that and they raise that, that raises the yields on all other assets and investment options out there. So when they raise the Fed funds rate, the 10-year treasury yield largely goes up. And when that goes up, a component of our overall interest rates go up as well. So generally speaking, when the Fed raises rates, it generally has an effect like it raises our overall interest rates. But not every time. It's an indirect relationship because the other component is this investor demand. And that 1.7% spread over time doesn't have to be 1.7%. Lately, it has been a lot larger than 1.7%, right? Investors have said, well, I didn't want to invest in mortgage-backed securities for a number of reasons, which we can go into. And so that spread was wider in the past. Well, what we've seen over the last month is that spread, that investor demand for mortgage-backed securities has come down. And because that spread has come down, even though the Fed funds rate is the same, that spread has come down. So our overall interest rates on the mortgages we pay have come down to the tune of about 0.75% over the last month.
Got it. So the change has been a difference numerically. The change has been a difference in about 0.75% in mortgage rates, right? And we're going to talk about how to think about that from an investor's mindset and what that means for you. But the reason behind it has essentially been a change in sentiment in the investor world of how much I want mortgage-backed securities, right? Essentially saying before didn't want it as much, now I want it more.
Yes.
And it's safe to assume, or at least my assumption, and you tell me what you think of it, is that comes from investors starting to get back on the wagon of like, okay, I think that the risk to prices dropping and to the housing market going into a correction and all these things have lowered now that we have been this long in this like inflationary period. The Fed has done this thing. Things are starting to even out. So I'm going back to my usual demand of mortgage-backed securities.
Well, the people who invest in mortgage-backed securities, generally speaking, are not everyday investors. They're billion-dollar pension funds and, other private equity type of investors out there, right? Because mortgage-backed securities are known to be one of the least risky assets out there. They only require a 1.7% spread premium over a risk-free asset, which is the 10-year treasury. So I guess what I'm saying is that these types of investors are not, they're educated, they're savvy. They know that home prices going down does not happen very often. It's very infrequent that housing prices would go down. So they're educated more than what I would call everyday investors.
Okay.
When they look to see, should I put a whole bunch of my clients' money in mortgage-backed securities? They're looking to see, okay, well, when I go and I have my clients' money invest in mortgage-backed securities, I know that that's going to be locked up for a long period of time. Generally speaking, people stay in their mortgages and in their homes somewhere around 7 to 10 years. So if you're advising your client to invest in mortgage-backed securities, you better make sure that you're getting a great return on that investment for them. And it's probably going to be locked up for 7 years or 10 years, until somebody refinances or sells the home. Well, what's been happening for the last year, 2 years in the overall marketplace is we've seen the Fed raise interest rates over and over and over and over again. And so if you're seeing that the Fed is raising interest rates over and over and over again, and you're seeing inflation largely be, not able to be tamed, the narrative there is that rates are probably going to go higher. Yep. So you, as somebody who's advising your mortgage-backed securities clients, you could say, well, listen, we could wait 6 months, and instead of getting a 6.5% return on our investment, 6.5% interest rate, we might be able to get 7%. We might be able to get 7.5%. But what we've seen lately, again, going back to inflation quelling and being stable, largely stable for the last 2 meetings, and you're seeing the Fed be largely stable. They haven't changed the Fed funds rate. The narrative now is switching to, have we reached the peak of the Fed funds rate increases? When are we going to start to see the Fed lower rates? And so now all of these folks that control a lot of money in mortgage-backed securities are saying, hey, client, guess what? This is a good time to lock in your returns, because this is probably the highest return that we're going to be able to get on mortgage-backed securities, because we actually see rates potentially going down in the future. And then if you waited 6 months from now, you might not be able to get a 7% return. It might be 6.5% or 6% or something like that. So that's really what's guiding their decision. It's not worrying about a housing crash, because people know that doesn't happen very often. It was an anomaly when it happened during the Great Recession. They're more thinking about, how can I lock in the best returns for a long period of time for their clients?
Okay. So then I'm going to take out the idea of house prices going down, and I'm going to reinsert just the summary of the people that invest in this stuff, and mortgage-backed securities are not your average investors.
Right.
Right. Like, these are the sharps, right? Like the big billion-dollar hedge funds that see mortgage-backed securities as a long-term bucket asset that they want to lock in and hold on and feel very, very safe around. In the last short period of time, their behavior has essentially said, we don't believe we want to push further in yet. In fact, they've retreated a little bit. And right now they're saying, okay, we think the worst part is over. We don't think that rates are going to continue to go up. It doesn't make sense for us to wait for a deal on rates anymore, because we think that rates right now are in this unique position that provides us a unique amount of return based on reduced risk because of what we see coming in the short term. Okay, cool. All right. So that's what's going on. That's why the rates are driven. Like we said, the rates have dropped 0.75%, and we are going to talk about what that means exactly for a return. But I think before we go there, for us, as not your average investors that are not in the sharps, that are not in the billion-dollar hedge fund perspective, we have been looking at this thing like, okay, interest rates are high. This thing's at the top of the market. It may not make sense for me to invest in a rental property right now because I think that rates are too high. They might still go up. I'm afraid that if they continue to go up, prices are going to go down, stuff like that. And people are waiting for rates to drop to invest. What do you say about that? What is the main thing to take away? Should people be seeing this rate drop as, okay, so now it's the time to invest, or should they be thinking this rate is dropping, it's going to now start to really drop, so maybe I wait a little bit longer? What's the overall takeaway from the investor at our scale?
Most people get it twisted as the right time to wait and the right time to take action.
Mhm.
Most people think when you buy rental properties, for some reason, it's buy and sell in 6 months or buy and sell in 1 year, 2 years, and 3 years. When you buy and wait, that's how you actually win. And then on the flip side, many people say, well, when interest rates are at their high, like they have been, I'm definitely not going to buy a rental property. But if we can step a few steps down the road here and see what will happen in the future as rates drop, you'll see that that actually is the wrong approach. That's the wrong approach. And we can look back in history. We can actually go back and see when there are significant rate decreases, the next thing to happen in the housing market is home prices going up. Mm-hmm. So while you still can get positive cash flow at high interest rates today, our approach, and for our clients, it's how can I stack these assets up right now, knowing that when interest rates go down in the future, like a lot of really smart people are saying over the next 1 to 2 years, interest rates going down, they know that the effect on housing prices means that you're going to get a bump from home price appreciation. And the other really good thing is that when home prices go down, because we have the most beautiful mortgages here in the United States of America, where you don't have prepayment penalties that are exorbitant, and many times you don't have any prepayment penalties at all, you can buy an asset today at a really high interest rate that you may perceive, call it over 7%. And guess what? When the rates come down to 6% or 5.5%, you just refinance. You just refinance. And that deal that was a good deal to begin with just became that much better. So for both of those reasons, because of the effect of lowering interest rates and rising house prices in the future, and because even if you're in an interest rate right now that's higher than you want, you can always just refinance it in the future. Because of those two things, looking at this opportunity right now as a buy time is the right approach. This isn't a time to sit back and say, oh, geez, I'm going to wait for interest rates to go down, because guess what? When the interest rates go down, the home prices will have already gone up and you will have missed out on some potential returns on investment.
Got it. And we've been hitting that message for a while on this show. This idea that when interest rates, that people believe that they got to wait for the interest rate to drop in order to get a better deal, right? But the converse is the fact that as soon as the interest rates drop, prices tend to go up, right? Like when there's a big signal from the Fed lowering interest rates, essentially, prices are going to go on a rise. We have the historical trends to prove that. And that's why right now we believe that this idea that these interest rates have dropped for the time being, right? This gives you the chance to say, you know what? I'm not getting the worst deal ever, right? Like there's been a little bit of a drop. So psychologically, it makes you happy to think, oh, interest rates dropped a little bit. It's also a signal of things to come. We believe that, nobody knows the short term, but this is the sharps, right? Like this is the $1 billion investment asset fund managers telling you that they believe that the top of the interest rate hike is here. And therefore they're coming to this asset class. And what that means for us as people looking at rental property investments is there is a slight dip in interest rates, which means my cash flow is going to go up if I buy right now versus if I would have done it a month ago. But more importantly, I get to get in, lock in on this appreciation that's coming when the Fed starts dropping interest rates and prices to the consumer start going way high. And I get to lock in that appreciation right now, which we have all grown to understand here on the show, that home price appreciation is the biggest driver of wealth when you're investing in this asset class. So you can lock that in now, still get a deal, get increased cash flow, and later down the line, once interest rates drop and your stuff has appreciated, you can refinance, get that lower rate later on, and it's a really, really good time to do it. So is that a pretty good summary?
Yeah, it's pretty good. I mean, there's always a reason that either you may be thinking or that a narrative is cast upon real estate is the there's a reason to not take action. There's a reason to not invest, and for the last couple of years, it was that housing prices had to go down, and it's been that interest rates are too high. Well, guess what? Housing prices haven't gone down, not in Jacksonville. Majority of the places in the country, they haven't gone down. Yep. And, and the interest rate conversation, you got to change your perspective on it, because the data is really clear. When interest rates go down, home prices go up. So we got to think differently about it to be able to set you up for success with your rental property portfolio.
Yeah. And Denny Davis is echoing that. Barbara Corcoran is saying that. The lady from Shark Tank is out there preaching the idea that stacking assets right now is the move, because prices of real estate will skyrocket nationwide when rates come down significantly, and you can always refinance, but you can't buy at today's prices later on. So let's talk about it. Let's talk about what buying at today's prices is. GC put together a little bit of a case study of buying 3 turnkey properties right now at the current interest rate of 6.125% versus the old interest rate of 6.75. Loans are 30-year fixed rate loans. Purchase prices of $240K each was about the average of the JWB inventory right now, putting down 30% on payments, total investment of around $241,800, which in this case was reallocated from retirement accounts to fund it, and buying and holding for 20 years. GC, you ready for me to put in your comparison?
Yeah, let's do it. So I wanted just to show you guys in real numbers, what does an interest rate drop of, call it a little bit over 0.5%, mean to you as far as the decision? And so here are the numbers here. How much more money do you make when interest rates drop? Well, for a portfolio of 3 assets that are purchased and held onto for 20 years, this is how much it would affect you. Now, 6.75% was the interest rate that JWB clients were getting about a month ago. Now, we've talked about how overall interest rates were getting close to 8%. When that was happening, JWB clients were able to get interest rates at 6.75%. And that's due to our relationships with our lenders, and also an aggressive rate buy down program that we are offering as an incentive to our clients. So that's where it was a month ago, 6.75%. Well, now, because of everything we just discussed, that same portfolio of homes can get a 6.125% interest rate. And so I've stacked up the differences here to see how much more that's worth. And I'll kind of go through some of the main highlights here. When interest rates come down, that means that your payments to the bank are lower, but your rent is still high. So that means that you get more net rental income to the tune of about $50,000 over the course of ownership for this portfolio. So it's worth 50 grand in net rental income to you.
Not bad.
Anybody like an extra 50 grand?
Everybody likes an extra 50 grand.
Yeah. If you made the decision a month ago, you didn't have that 50 grand coming to you that you now do, just by the interest rates dropping like they do. But again, if you bought a month ago, don't feel bad. You're going to refinance anyways. You're going to be just fine. Then you've got tax savings, right? You get more tax savings, the more net rental income you have. So as the interest rates have dropped a little bit over 0.5% now, you made an extra 4 grand in tax savings. Every little bit helps, right? Principal pay down now, because interest rates again have dropped, right? Interest rates are lower. You pay less in interest on your mortgage payment every single month. You're going to make an extra 10 grand of return on investment. Your home price appreciation is still going to be strong. There's no additional home price appreciation because of interest rates specifically, although we would expect home prices to go up in the future when interest rates do come down, but I didn't put that in here. So all in all, it's worth about $64,000. Just that interest rate drop, a little over 0.5%. It's a $64,000 bump to your profits in this rental property portfolio, which takes you from about a 9% return on investment every single year to roughly about a 10% return on investment every single year.
There you go. So this interest rate drop, mostly it's a difference in cash flow, right? But it also affects tax savings profit center, also affects principal pay down profit center. Doesn't affect home price appreciation, right? Your home price is still going to continue to appreciate. What affects home price appreciation, which is the biggest bucket, is how long you've been there, right? So this is the argument for why it makes sense to get in as soon as you can, because people like to buy real estate and wait. GC, is it safe to say that this is for 3 homes? So if you're thinking about 1 home over 20 years, you're roughly thinking that per home it's going to earn you an extra like $22,000.
There you go.
Okay, cool. So that is the savings when it comes to buying now based on this interest rate drop. So my takeaway there is, all right, if I want to feel like I'm going to get a little deal, there's a little deal for me, right? Not life-changing money, right? Over 20 years, the extra $20,000 per property makes a difference, but maybe not a giant difference.
Mhm.
But there is that idea of, okay, I didn't buy at the top of the market. Now let's talk about what's coming if I was to buy it right now. What is coming now, GC?
Yeah, that $65,000 is nice to have, but that's not the main takeaway of our hour that we're going to spend together. The main takeaway is that this is a leading indicator. All these large economic things that we've just been talking about here and how the Fed is holding the Fed funds rate constant, and CPI, consumer price index, is getting closer and closer to our target, and it's holding firm. And you've got a lot of really smart people out there talking about not how rates are going up, but they're asking when are rates going to go down. So I pulled some of the quotes here. One from the National Association of Realtors, the chief economist, Lawrence Yun, who's quoted all the time. His outlook is that mortgage rates look to head towards 7% in a few months and into the 6% range by the spring of 2024. So that's pretty aggressive, right? We're at 7% now. So he is talking about rates dropping a full point by the spring of 2024. To put that in perspective, that would be a 1.5% to 2% drop of interest rates from their peak.
That's steep.
So that's pretty aggressive. You've got U.S. senior analyst Crystal Sunbury. Assuming no significant economic shocks, mortgage rates are likely to continue slowly easing over the next few months to reach a 6 to 6.5% range by the spring of 2024. So collaborative and corroborative there. Mortgage Bankers Association is their forecast is for mortgage rates to end 2024 at 6.1% and reach 5.5% by the end of 2025.
It's like a 2-year outlook.
2-year outlook. Bank of America head of retail lending, Matt Vernon, says the Fed's likely decision to cut rates in 2024 would be a key factor that could breathe new life into the housing market. And then Ally Home President Glenn Brunker says with the mortgage rates pricing around 7.5% today, we can expect them to be nearing their top and begin their descent in the first half of 2024. So a lot of this is seeing the writing on the wall before it happens and understanding what the impact is on your home prices and your overall portfolio when interest rates come down. Because we don't know exactly when they're going to happen, but I haven't talked to one individual out there who thinks that the Fed wants to keep the Fed funds rate this high, and by indirectly that we would want interest rates to be this high. Everybody knows they're going to come down. So if you know that they're going to come down, what can you do to put yourself in a position of success, get extra profits out of this equation? And that's why this is a buy time.
Yeah. These quotes that you read off of these experts seemed more aggressive than how you normally talk, right? Like there's like a handful of people saying that it's going to drop like a full point within the next 2 quarters, essentially. Right, if they're talking about spring 2024, there's other people saying like 2 full percentage points by the end of in 2 years. You have a different tune, GC, right? Like, tell me what you think is going to happen and what you feel like you know is going to happen.
Well, I think it's a lot easier to be an economist and make predictions versus when you're the person responsible for delivering returns on investment to folks. Of course, all of our returns on investment and property evaluations of portfolios we built, we have to be conservative when we talk about what interest rates are currently at right now. And then we don't want to bank on them coming down at a certain time, because otherwise that could make it difficult for us to perform and hit those returns on investment. So we're always very cautious here. And the main point here is that I'm never about timing the market, but when I know that something is going to happen, I want to put myself in the position to benefit from it. So a couple of things that I know are going to happen. I know that supply right now is undersupplied for housing. And I know that it's going to take a long time for us as an economy, as a country, as a market here in Jacksonville to bring enough supply into the marketplace so that you don't have significant pressure on prices going up. I know that. So I want to put myself in a position to own as many assets as I know you have that macro pressure on upward pricing. Something else I know is that I know interest rates are going to come down at some time. And I know how interest rates affect home prices. So if I know that that macro trend is going to happen, I want to put myself in a position to own as many assets before that happens. Now, I don't know if that's going to happen in spring of 2024 or summer or in 2024 or 2025, but I know it's going to happen. And I know that relationship. And I also have a long-term view. So I'm not sitting here saying that home prices are going to skyrocket in 2024 because interest rates are going back down to 5%, in spring of 2024. What I'm saying is look at the macro trend, connect the dots. And if you are into this asset for buying and holding, like you should be for this asset, you can easily start to understand the narrative here that you're putting yourself in a position of strength. You are maximizing your profit potential to use these leading indicators to make a great decision. And that great decision is to stack up your assets now because interest rates are going down and because there's an undersupply of these types of assets in the marketplace.
Oh, that well said. And, this idea of, the telltale signs or whatnot, what you are betting on is what I just shared here in the chat, right? Like this idea that in the last scenarios where interest rates have dropped 2.8, 1.5, 2.2, 1.1, 1.11% across different time periods in history, what you see is an overwhelming data set that says the market then goes up, right? Whether it's 6%, 4.7, 4.4, 2.5, 8.9, and then there's the outlier of 2008, 2009, where it also went down because of a correction caused by the housing market, but we don't believe that that's what's happening right now. That is not the signpost. The signpost is that it's going to perform much closer to like what happened in the 80s because it's much more similar to what we've been seeing happening. A long period of interest rates rising in order to quell inflation, and then a stabilization, and then interest rates dropping again. And then the early 80s, we looked at the spread of like 6, 4.7, 4.4% appreciation that happened right after, which if I'm doing the math, right, on these like $240,000 assets, if what we are looking to is, either save 20,000 over the next 20 years or lock in ahead of like, let's say on the low end, 4.4% appreciation. Can you do some quick math on what that looks like, GC?
What's the math we're asking for here?
4.4% appreciation in a year of
yeah.
$140,000 assets.
Yeah. So, I mean, that's 12, 13% or $13,000 a year.
Yeah. So if you're essentially looking to save 20,000 over the next 20 years or lock in 4.4% appreciation that you believe is going to happen in the next year, you'd be essentially tripping on dollars to pick up pennies, tripping over dollars to pick up pennies, if that's what you believe is going to happen. And that's why the recommendation from GC is this idea of like, hey, for those of you that are looking for a deal, looking to not be at top of market, we're officially no longer at the top of the market, right? Like this thing, I don't know if I'm allowed to say that.
It was top of the market. You're talking about interest rates? Or you're talking about home prices? The
combination of it all, right? Like the combination of cost of buying right now has gone from like an all-time high of prices and interest rates to now there's been some relief on the interest rate side, right? So you can count on that part to like tell yourself that, hey, I'm not,
you're starting to see the signs. It's like your return on investment has gotten instantly better. You're starting to see the leading indicators, right? Maybe some of us weren't confident enough to do it before we actually saw some softening in the interest rate environment, but now we see it. You see mortgage applications going off the roof, right? Everybody is applying now that they've seen some interest rate relief. That's a leading indicator for housing demand. You're starting to see it. Well, go ahead and take that next step. Take that next step. Secure hard assets right now. Again, because as interest rates go down, you win two ways. You can refinance. If the interest rate goes down, like we're saying, like most people are saying, you're just going to refinance. Right? It's a few $1,000s for a refinance cost, and it'll save you. You'll make that back depending on how much interest rates go down. You can make that back in less than a year. And then on the other side, you're putting yourself in a position to own the asset before interest rates do what they do, meaning when they go down, home prices go up. So you're setting yourself up for a nice bump of equity to get into your portfolio.
Yeah. And speaking of setting yourself for a nice bump of equity into your portfolio, this incentive by JWB that is still running through the end of December 31st is another deal to throw into the equation that you can take advantage of. You want to tell people about that?
Yeah, absolutely. So the way that we've been taking care of clients in this higher interest rate environment over the past close to a year has been aggressively buying down the interest rates for our clients. That's how, when rates were close to 8%, JWB clients were at 6.75% for their interest rates. Well, now we're still offering those incentives, but we're also seeing rates already come down. And so at some point, I wanted to be forthright with everybody and let you know that we never do incentives at JWB. These incentives that we've done have been a result of interest rates being so high. At some point, we are going to take those incentives away. And so what I wanted to highlight here is I know that we're going to be doing the incentives, which come out to about $5,000 of real incentives. We're going to be doing those through the end of this year, but I don't know how long we're going to be doing those. A lot of those depend on what the overall interest rates are for the marketplace. Depends what the Fed does, depends what the investor demand is for mortgage-backed securities, all those things we were talking about. So this is an opportunity for you to purchase homes, get that $5,000 in incentives because JWB is paying for that for all of our clients who put properties under contract by the end of this year, so December 31st. You can use that towards JWB continuing to buy your rate down for you, just like we have been doing for all of our clients. If that's what you would like, it's best for your goals. We're going to help you figure that out. Or you can just use that as a cash incentive. It doesn't have to be used as a rate buy down. Now, we need to talk about what's the right approach for you. So that's why you need to get on the phone with JWB and we can walk through that scenario. But that's $5,000 per property that you put under contract by the end of this year, and a huge incentive that will not be there as rates do continue to come down as we get into 2024.
Beautiful, man. So we're going to get into Q&A. We got some really good questions here in the Q&A from some of our favorite people. But the overall takeaway here is we have been going through an elongated period of high interest rates and high prices that have made us all gun shy to invest in this asset class of rental property investing. Us on the show have been saying, hey, yes, this is happening, still a great asset class, but what you really need to know is that this asset class right now falls under the whole be opportunistic when people are scared and be scared when people are being overly greedy. And right now that people are scared is the moment of getting in, because the moment that the interest rates start to drop, when the Fed starts signaling that they are dropping interest rates, prices are going to go way up and you're going to miss out on home price appreciation. And that's why right now that the rates just dropped, not from a Fed interest rate price adjustment level, is a great sign that things are leveled off and what we've been saying is going to happen sometime soon. And it provides a unique opportunity for you to get in, saving a couple bucks on the interest rates right now, which amounts to about $20,000 over the next 20 years per property that you can get into. You can also double down on the fact that you're also getting the JWB incentive right now, which is $5,000 if you are doing this before the end of the year. And you are getting in before prices start to really go way up, which is going to be where you're going to be super pumped about the wealth that you created for your retirement, for your family, for all the different things that people invest for.
100%, man.
Okay. So anyways, if you want to do that and you're not already a JWB investor, you go to chatwithjwb.com and start a time, or just shoot an email to info@jwbcompanies.com. GC, you ready for some questions?
Let's go, baby.
All right, baby. We got Stevie B in the house saying, are these effects carried over into self-directed accounts? And what is the current rate for a self-directed acquisition today?
Are these effects carried over into self-directed accounts? Yes. So self-directed accounts are indirectly affected just like every other interest rate and mortgage product. It's different though. It's, the pile of money that goes into funding and supporting your self-directed lending platforms is very different than the mortgage-backed security platform. So it's a much more niche market. So overall, yes, your interest rates for your self-directed and retirement account non-recourse loans have definitely gone up as a result of the things that we've been talking about here, but it's not hand in hand. I don't know what the premium would be over the 10-year treasury. I don't know if anybody knows that historically, to be quite honest, but it's not as lockstep and understandable, to be quite honest, because it's such a niche market. Overall though, your interest rates on your non-recourse loans, Stevie, you probably just want to reach out to the team. I don't know off the top of my head. I don't want to give an answer there. So just reach out to the team, shoot an email to info@jwbcompanies, which we can get you the most recent rates that we're getting for our non-recourse loans for our folks that are purchasing through retirement accounts.
Okay. So just to clear it up, Is there any extra savings right now based on this rate reduction for self-directed IRA account or like for self-directed retirement accounts?
I don't know if the rates have gone down
sure.
in the last month. My guess would be, so that's kind of what I was saying. It's not as much of a developed marketplace as overall mortgage-backed securities.
Got it.
So it's much more dependent on the pile of money that is supporting the lending platform, which might be just like one decision maker or like 5 decision makers.
So it's a maybe.
It's a maybe. I don't know if the rates have come down. They're usually more sticky. They move less than the overall, long-term 30-year fixed rate mortgage market.
Got it. Gerard Wendling is saying about 3 months ago, Bridge Capital was 12%, and Bridge was at 12% last month, according to Dean. So just a data point. Worth an email to your team if you're already an investor, or if you're curious about this and you want to invest in your self-directed IRA, or 401k or solo 401k, worth going to chat with jwb.com to talk to the team about it specifically for you. Mike Foster has another question. What do you find is an average overall cost of refinancing with the lenders JWB works for, GC?
I haven't really looked at the specific cost of refinancing in quite a while. So, I'm going to say a few $1,000s is just a rough number there. Something that when interest rates go down, it's an easy decision. As interest rates go down like we're expecting, it's something that should be an easy decision for anybody to refinance.
Future show suggestion.
Yeah, we can do that.
Actual cost of refinancing. Thank you, Mike Foster, for giving me that one because I'm working on next quarter's show topics as we speak. The MVP of the community here, Lee Bishop, you may have heard of him.
I think I have. I think I'll be seeing him soon.
Yeah, that's right. He's asking, in your opinion, Greg, how much of an interest rate drop do you think it would take to make sense for an investor to refinance? Is it 2% to break even in 5 years to make up for the cost of refi?
I don't have that number right in front of me, but we could do that analysis pretty quickly. So it's a relationship between how much more cash flow you'll earn from refinancing, how long are you going to be holding the asset so that you figure out the amount of profit that you would make on that trade. And then we need to know exactly what the cost was for the refinance. So maybe we go through that exercise as well. I think we're putting together a really wonderful show. What do you think?
Really wonderful show. I love it. All right. Mike Foster asks, and can those refinance costs be wrapped up into the new loan?
Can the refinance costs be wrapped up into the new loan? Yeah, I think it can. Let me nail that one down too.
Our costs. I'm putting this all as like future show suggestion. Our costs wrapped up in your loan. Our costs wrapped up in your loan. I love this. Denny Davies asked the question. Greg, the not your average investor move for many listeners here would be to set aside JWB's 2% rate buy down credit, take the higher mortgage rate now, then use the 2% of cash to help pay for the refinance to a lower rate in the future. That move would likely close that 0.7% gap in your chart.
Yeah.
What about that?
I think it's a great insight. Danny knows what he's talking about here. If he's looking at it from the lens of what's the best return on investment that we can create for a client. So when we're bringing a client on and building that portfolio for them, that is one of the lenses that we're looking at. And if you're looking at how can you maximize your returns, you should do exactly what Denny said there, which is to take that incentive, that $5,000 incentive that JWB is offering, and take that as a cash incentive. Hold on to that. And then as interest rates come down, which they're going to come down, we all believe they're going to come down in the future, then use that incentive to, in essence, pay for the refinancing costs. You would largely have something left over. And you basically would have had a much lower interest rate because the market drops that way. And you would have paid for it with the incentive and you would have had some cash left over. That's the best return on investment move. That's not the best move for everybody, though. A lot of our clientele wants to look at this as set it and forget it. Maybe a lot of our clientele doesn't want to take the risk. Interest rates may go up at some point in the future. I guess that might be a viewpoint for some folks. There's a little bit more risk with that approach as well. The biggest risk, though, is that in order to do that, many times you'll go cash flow negative, right? If your interest rate, you'll either put a lot more money down or you'll go cash flow negative because what JWB does with this $5,000, which is, it's a rough $5,000. It's actually 2% of the purchase price is what we contribute. But what we do is we drop the rate. When we drop the rate today, that's how you get 6.125%. That in essence makes you a lot more cash flow positive. So if you are somebody who has enough passive income already, or is somebody that wants to really maximize the profitability of this asset, do what do what Denny's talking about here. That's probably the best return on your investment. However, if this is your first time getting into rental property investing and you don't want to take maybe some of the, leaps that we're talking about there, if you just want it to be set it and forget it, we can just use that seller concession, buy down the rate for you. It's cash flow positive from day one. And then, you're kind of hedging your bets, because as interest rates drop lower than 6.125% at some point in the future, like we would expect, you can still refinance later down the road. So I won't say it's one size fits all, but Denny, you're 100% right. That is the best way to produce the highest return on investment.
Okay, so I'm going to summarize that real quick. And just in the scope of today's conversation, Denny popped in the Q&A, this idea of setting aside the JWB incentive, right? Right now, JWB has this incentive going on through December 31st, 2023 of $5,000, which JWB uses to buy down the rate that you are financing your property at, but you don't have to take that incentive and buy down the rate. Denny is saying, if you want to take a little bit of extra risk and increase your return on investment overall, because the crux of the argument that we're saying is that rates in the future will go down, right? Because of what we're seeing happening in the market right now, he's saying that you can set aside that $5,000, buy at the rates today. Once the rates actually go down, like let's say these super aggressive predictions that we just read out, that'll happen in the next 2 quarters. If that happens, pounce on that. If it takes a little bit longer, pounce on that. And what you will effectively have done is gotten in and guaranteed yourself to participate in that upward appreciation of housing price that happens when rates go down and the Fed lowers the interest rate. And because part of the strategy is that you're going to refinance anyways, you're supercharging that refinance on the back end and therefore increasing even more your total ROI, which makes up for the gap of if you were to purchase tomorrow versus today based on interest rates going down.
Yeah.
Okay.
Let me just add one thing. What Denny's talking about there, a month ago, if you made that trade, you would have made $5,000 more. So a month ago, when that $5,000 incentive that we have been offering, if you use that to buy the rate down, it would have dropped your rate about a half a percent. Well, over the course of the last month, rates dropped a little bit more than 0.5%. And so if you made that same trade like Denny's talking about a month ago, you could have taken that $5,000, put it in your pocket, and then you could have seen interest rates drop to what they are today, and you could refinance it sometime in the near future. And in essence, you would have gotten there and then still kept that $5,000 in your pocket. So it's a good trade there. There's a little bit more risk to it. It's not exactly set it and forget it. And you generally do need to go cash flow negative in order to do that, which are some of the reasons to not do it. But either way, talk to our team. We'll figure out the right strategy for you.
Definitely a not your average investor strategy, Denny. Totally as billing. By the way, also teasing another future show topic, we're going to get into cash flow negative situations and see how that makes sense for investors and what type of investor and why you would do it or not do it and how you would do it or not do it. So that is another future topic that's coming up. And our final question here, our patron Santorios of the community, Michael Santorios asks, Greg, it's important to consider how long you've already owned your current loan before refinancing. If you're 5 to 10 years in on a 30-year fixed rate, you're now resetting that 30-year window, adding 5 to 10 years of payments.
Great point. So what Michael's talking about is getting the most out of your principal pay down profit center. And in that profit center, the longer you hold on to the loan, the longer you hold on to the home and have that loan, the more principal pay down happens every single month. And it starts to add up every single year. So if you've owned the home for a long period of time, it needs to be even more of a rate reduction for it to make sense for you to refinance. Versus if you've only owned the home for 1 year and you see a rate drop available, then you probably pull the trigger even if the rate didn't drop as much. So another benefit of holding for the long haul is that increased profitability of each profit center, and something else to take into account when you're deciding when the right time to refinance is for you.
Cool. And a final question here based on this JWB incentive, which we'll show one more time. GC, the Shawman, Nadeem Shah, says, is the $5,000 paid in cash to the investor or is it put into the investor's account with JWB?
It is paid in cash, which ultimately just reduces the amount of out-of-pocket expenses for you on your HUD settlement statement. So it's all on the HUD settlement statement. It just reduces that amount of capital. It goes right in your pocket. You didn't have to spend it.
Got it. So final takeaway from the show, interest rates have dropped before the Fed actually moves the levers of the of dropping the Fed's funds rate, right? Which means that there is a unique opportunity right now to invest in rental properties, save some on interest payments, increase your cash flow based on these drops, but also lock in on what the sharps are doing. They are betting that we are done with interest rate hikes because the economy is stabilizing. You can do the same, understanding that what follows is the Fed following suit, lowering the Fed's fund rate, which has shown over history to create a upward movement of housing prices. You get to benefit from that home price appreciation right now, plus the extra dip in mortgage rates that just happened, plus the JWB incentive that runs through December 31st, 2023. If you do that right now, GC, how did I do?
I think you nailed it, man. I like, when we do those little shorts there, I think you just crushed it right there. Sign you up.
Did I just make it to the short?
You did.
Oh, look at me. Look at me. Speaking of making it, we had over 65 people make it to today's call, and that is amazing. We love when the community shows up like this. It tells us that we're putting together content that you find valuable. And just like that, content that you find valuable, we've had a couple people in the chat, RSVP, saying that they are already saving the date. Just going to read it out, give you a little love. Danette has said she's coming. Dean has said he's coming, the early bird, of course. Mm-hmm. The ringmaster, Drew Barnhill, said he's coming. MVP Leah said he's coming. Mountain Bella Green has said he's coming. Our favorite fiduciary, financially fee-based financial advisor, Kelly Barenbaum, said she's coming. Danny Davis and Erica, who is the elusive Danny Davis, one of the highest attended folks, but doesn't come on camera very often. He's coming all the way from Arkansas. We got Right Along Raj coming back.
All right.
Right along with him again. We got the Maven, Leslie Wilson from the mountains of Colorado coming. We got Jen, the fairy godmother, and Renee say they're coming. Joni said she's coming, and Nadeem has said that he is coming.
This is going to be amazing, guys.
1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 people already saving the date.
Yeah, with guests. I mean, we're thinking we're going to hold this thing to 50. So with guests, and teammates there, it's going to fill up quick, which is exactly what we want. And we want it to be the right group. We are not here trying to have this be a 1,000-person event. We want to keep this special the way it's been for the last 3 years. It's definitely going to be special with those folks joining us.
Definitely going to be special. Folks that joined in late, like Steve VB, saying coming to what? Coming to the Not Your Average Investor meetup that we're doing February 16th and 17th. Steve VB, save the date. You want to be in Jacksonville the evening of the 15th. Bill Shields, a local and a legend, also said he's coming.
All right.
So we're going to have him there as well. Good show, GC.
This is great, man. This is great. It's good to be back in the saddle with you.
It's good to be back in the saddle with you too, man. Different energy when we do it here.
Is that a 2-person saddle that we're on?
Are we two cowboys riding horses next to each other, or are we double-seater on one horse? I will let you decide that. I hope to see you on Thursday when we are going to be talking about how to understand market indicators and dynamics independent of timing, right? So we talk a lot about timing, but really a fundamental understanding of like what market is right for you and why is something that we want you to have, so that you're not only investing because we tell you to invest with us, but because you understand it the best way possible. So we hope to see you on Thursday. In the meantime, if you want to take advantage of this unique opportunity, go to chatwithjwb.com, book a time, start talking about this thing so you can get in before this extra incentive jumps out, finishes. You get the extra home price appreciation. But from now till then, any advice, GC?
Don't be average.
See you Thursday.
See you.